Hello, everyone. Welcome to this Kenanga Banking Sector Outlook in for the long game or short game webinar brought to you by Kenanga Investment Bank in collaboration with Bursa Malaysia and managed by Wealthford. So today we are going to explore the banking sector outlook. All right. So welcome everyone. My name is Clement Chua. I'm the moderator for this session. Now, amid the hawkish macro environment, so we know that central banks are raising interest rate. So banking sector will stand to benefit from this hawkish environment. So today we are going to look into the banking sector to see where are the opportunities within this sector. All right. So before we proceed further, just let me tell you more about this Kenanga Humankind project, which is a CSR project undertaken by Kenanga Investment Bank. So you may Kenanga is raising 50,000 ringgit for this disabled employees at the cafes include. So you may support this cause by scanning this QR code by pledging a meal at 20 ringgit only. So for every meal that you pledge, Kenanga will match meal for meal. All right. So at least 2 persons will not go hungry. And this will sustain employment opportunities for the disabled employees who are working at the cafe includes, and it will provide training and development to these disabled employees at the cafe includes. So for all the meals, right, it will be distributed to the children in need. So just 20 ringgit if you are, if you are feeling to help these disabled employees and also the children in need, you may scan the QR code on the bottom right corner, and it will take you to the Kenanga Humankind project, right? Where Kenanga will match a meal for meal, right? Just a little shout out for CSR project done by Kenanga Investment Bank. So disclaimer for this webinar is that whatever we share in this session is only for educational purpose. So if you decide to make any investment decisions, you're 100% responsible for all your investment risk. All right. So today we are very fortunate to have invited Mr. Clement Chua, who is the senior equity analyst from the Kenanga Research, to share with us about this topic for the long game or short game for this banking sector. So without further ado, let me invite Mr. Clement. Clement, how are you?
Yep. Hi, Shane. I'm good. And thanks for having me in this session.
All right. So I will just hand over the session to you. You may go ahead and share your screen.
Right. Yep. So hi, good evening, everyone. Just give me a second. Right. So I'm here to really discuss about the banking sector, as Shane has pointed out, and why this title, in for the long game or short game. It's because now we're in this environment where the macros are very uncertain. Like we just got out of COVID, and right after COVID, we have this unfortunate Russia and Ukraine conflict, which as we all know, is putting quite a number in terms of the global supply chain, and as well as how commodity prices are affecting some of the economies. And unfortunately, a lot of these macro conflicts do translate to very material impacts to nations. And I think the first one we've seen to crumble is Sri Lanka. But we do not hope that this happens to Malaysia as well. We do think it's quite a long ways to go before we are in such a detrimental situation. It is still something that we have to be cautious about. And to link this to today's topic, it's because when we look at the banks, typically we would see the banks as a more stable investment sector because they are hinged against the local economy. They are essentially the backbone of the country, because without a place to keep our money, without a place to find loans and financing, there would not be any growth within an economy itself. And hence why looking at the perspectives of how banks have been performing, if you were to position yourself in the short term or in the long term, what kind of what kind of risk and rewards are we looking by putting ourselves within the sector itself? So just really briefly, the real key discussions here would be really just touching on these few things first. I would like to discuss first and foremost like where we are right now in terms of the banking sector. And after that, a bit more, just to be a bit more technical into what are the key numbers or factors that we look at when considering the banks. And really the meat of it is the third point, which is how the banks have been performing if we were to look on a short-term and a long-term perspective. This is really where we dug through a bit further historically and see how well you would have been performing if you did put yourself in certain strategies. And thereby after that, I would give a broad explanation as to why we have our calls and recommendations for the stocks within the sector itself. Right, so on to the first point, and I usually like to start with this, really just to send the point back home as to why banks are really important within the equities market. It's because we all look at the KLCI index, and the banks, 5 of them, the largest 5, they are the leaders in terms of how we see the KLCI move within the market itself. Public, Maybank, CIMB, I'm sure we're all very familiar with those names. Those are the top 3 in terms of size and market cap as well. Hong Leong and RHB, they are the smaller banks out of the 5, but that's not to discredit their position within the sector itself. The other 3 conventional banks would be Affin, M-Bank, and Alliance Bank. We also have 2 Islamic names, which are MBSB and Bank Islam. But yeah, essentially, if we look at the KLCI for what it is the accumulation of the top 30 companies within the Malaysian listed scene, and it is typically used as the gauge to how we get a feel of the overall sentiment of the market. So yeah, that's it. We cannot ignore banks. It is highly crucial in the investment community. So really just to touch a bit on what has happened recently within the sector itself. It's all because of COVID. We did see a lot of movement restrictions coming in, phasing in and phasing out. Some of us may have been emitted because of COVID, but ultimately one of the biggest hits that we did see is because with movement controls coming in, a lot of economic activity was put on a standstill. And this called for moratoriums to happen over the last span of 2 years, in line with the MCOs. And really what these are meant to do is that they're supposed to help to control the damage done to the cash flow of businesses and as well as individuals when COVID came in. Just as a sense that we do not want people to default just because they could not work or businesses could not operate. And so hence why we had these moratoriums and also some repayment assistance programs that we are still seeing ongoing right now. And of course, when we look at this by nature, not having to meet your payments, of course, we would think that this is something that will be damaging to the banks because they, the cash flow relief that we see from the personal point of view would, will have to be borne by the banks themselves. And so this is something that has really caused has really shaken up the banking sector as of late. Hence, it's always worth reminding as to why we had to go through this over the last 2 years. The first one was in 2020. The second one was in July 2021. And after that, we are still seeing some repayment assistance programs coming on recently. The most recent one is URUS, the one that is you can see on the right side of the screen. And this is something that is really exclusively for the B50s, because I think the government did also realize that this moratorium, some people are also abusing it. Like they do not need the cash flow relief, but they are applying it for it as well. So this is something that's a bit more targeted, and I would have to say, at least looking at the sector over the last year since it's been enforced, that it has done some good to the people. And of course, when we talk about the banks, we talk about interest rates. This is the overnight policy rate by Bank Negara. And well, I think we can see from the headlines on the left, and we've probably all been following it quite closely as well. Since COVID came in, we did come to the record low of 1.75% in the OPR readings. And this did stay for quite a while. For those who have current commitments, I think we can see that there was quite a bit of savings that we did incur on our end. But sad to say that the OPR does serve a bigger purpose, and that is to help us to cope with inflation. And because the lower the interest rates are, by default, that is supposed to help to spur the demand for more lending. And with more lending, that is what's supposed to fuel the economic recovery that we are supposed to be seeing at this moment, with the seizing of MCOs and the reopening of borders. But interest rates are looking to come back. We did see 2 hikes over the last few months itself. Sad to say that we are expecting another 2 more. That's our Kenanga expectations. But still, although we are not at the heydays anymore of low interest rates, I think some of us we still do miss those times back in the day where fixed deposits actually do mean something. I think right now probably we're looking at somewhere less than 3%. Probably a very small handful of products are offering at that level, but it's nothing that's very attractive at this moment. And this is also something that is causing some retailers to decide about where they should put their money. So it's a double-edged sword, but we are expecting another 2 more hikes to come within this year itself. Of course, again, this is to curb inflation, because we do not want a situation whereby the economy grows too quickly, but prices are also coming to a level that is a bit too difficult for the normal retailers to cope. And I think coming again to the point of Sri Lanka is that this is something that we've seen. I'm sorry, Cambodia. That's something that we've. Sri Lanka. That's something that we have seen at this moment, and this is one of the key monetary tools that we are looking at to keep the economy in check. Something that is also of interest as of late, Bank Negara did release 5 digital banking license, although it's not something that would shake the industry right off the bat, because Bank Negara did give the banks 5 of these names, or 5 of these consortiums, I should say, 2 years to build up the backbone and infrastructure towards how they would launch themselves into the market. I think for those who have been following the names, we can see it right there. Probably the ones that we are more familiar with would be Boost and RHB, because Boost is one of the largest e-wallet companies within the country itself. RHB is also one of the big 5 banks. A bit lesser known would probably be the likes of C and YTL, because they are predominant. C is predominantly still a Singaporean company. GXS, it's actually Grab. Grab X Singtel, because they do have a digital banking license, but in Singapore. And they are looking to bring whatever they have learned in Singapore over to Malaysia. And this is supported by the Koch Brothers Group. Aeon Credit is also a name that probably some of you are more familiar with. They are tied with Aeon Financial Service, which is the parent company in Japan. And also MoneyLion. This is a listed company in the US, but they are coming in to help facilitate the launch of the digital banking products and services that the Aeon Group would ultimately launch. A bit of a surprise was CAF. I think probably not many of us use CAF because they are fairly small in terms of the retail market. But I think we do have some level of exposure towards CASM and what they do provide. And Junexu, probably nothing. It's not very familiar name, but I think we can all it will all ring a bell if I tell you Ringgit Plus, because that's really where the Junexu's leading website at this moment. Money Match is also not too much of a big player, but ultimately this group of 4 is they are coming together to release their own set of digital banking propositions going forward. But again, this is not something that will happen so soon. 2024 is when we will probably start to see all 5 of these banks go live at this moment. But the distinction between digital banks and the normal banks is that digital banks by its very nature, it's supposed to be non-physical, meaning to say they have zero branch operations. So everything you can do it over your laptop or over your phone. And this is something that would help to make the industry a bit more lean in this sense, because there is a lot of mention that the banks are a bit more. It's a bit crowded at this moment. We do need more efficiencies to come in. And digital banks are supposed to be one of the more efficient structures in terms of how do you facilitate financial services in this country.
Clement, are you able to speak closer to the mic or speak louder a bit, because there are feedback that cannot hear you very clearly?
Okay, is this better now?
I think so. Can you?
Is it better? Yep. Hi.
Okay. Yep.
Yep. Okay. Right. Sorry about that. Okay. So I'll dive into the next section, industry fundamentals. So all the things that I have said, they do translate to something within the banking sector itself. And I will start by something that is a bit more relatable, which is the GDP growth that we usually track on a very macro basis. Okay, we do not have the June numbers as of yet. It will be released tomorrow. But the purpose of this chart is really to show that regardless of how well or how poorly the country has been performing, loans growth is almost a constant. And why this is so is because coming to this slide, also expanding on it, is that you do see that when we look at loans, it comes in two sides really. One is the business front, and the other one is the household front. Basically meaning the hire purchases as well as mortgages. Yeah, so even though businesses might not perform as well, we did see over the last year itself where the interest rates were low, household loans did pick up in quite a meaningful way. And I think probably a handful of you would have probably taken the opportunity to pump up or maybe acquire a few new properties, to put to your portfolio, just to enjoy the benefits of the low interest rate environment. So that did translate, or that did hold the sector quite well itself. And of course, now in this environment where the economy is supposed to pick up, we do expect businesses to start demanding more financing. Even if it's not for the day-to-day working capital, we do expect a lot of the businesses that did not really do so well because of COVID to make a comeback. And this would really be the likes of your tourism sectors, your retail sectors. I think we can also see that some malls are probably not fully occupied, but slowly they are coming back up. Foot traffic is also quite heavy at this moment. Whether that's a good or bad thing, I think some people may argue differently. But fact of the matter is the economy is picking up again, and this is something that would be ultimately favorable to the banks. And well, the point of this chart to highlight on the right side is that although we only have June 2022's numbers as of now, just really a simple estimate of thinking that we can see a flattish growth on a month-to-month basis, we can still see that loans growth or the industry levels will hold up quite strongly at the rate of between 5 to 6%. And probably this will give you some level of comfort as to where the sustainability of your banks in terms of their top line would be held. Because unless we do see loans come down on a very big way, then probably that's where we would have some worries about whether the banks are sustainable or not. But in this case, or even proven as to this slide over here, the banks are quite well held. They are not as badly exposed as like some of the manufacturing sectors who are a bit more sensitive towards macroeconomic developments that which might be a bit unfavorable to some instances. Okay, moving on. To touch on OPR, so it is the interest rates that the Bank Negara would charge for the overnight lending between the banks. But what does that mean to the profitability of the banks? So I think we all know that if you take a loan, you need to pay the bank interest. If you put in your deposits, the bank will pay you interest as well. So the net of this would be what we call the NIM, net interest margin, between the banks. And we can see from the dotted red line over here, that's where the OPR readings have been. And since we came down to the level of 1.75, we can also see that the interest margins of the banks are creeping up, but plateauing closer towards the more recent periods. And the answer to this maybe is something that we as consumers of the banks are really not too happy about. But the fact of the matter is, interest deposits did come down more quickly than the interest rates of our borrowings. But of course, to the banks, that is a net positive for them. Hence why we see this stable trend in such a way. But that said, looking on an investment standpoint, we do see that there is a flattening of the interest margins, and that's because having been sustained at such a level for such a long time, competition is due to arise, and that would mean banks charging more competitive loans, higher interest rates for deposits as well. So having to see an increase in OPR would actually help to break off this trend whereby profitability will be a bit flattish for the banks going forward. I guess as of now, that shows that there are two good factors for the banks going forward. Nothing too much to worry about that I can see. Right, so another thing that is also widely tracked if you want to compare the health of the financial system is the quality of your assets. And I think, as we all know, when you do borrow from the bank, sometimes there will be defaults, and that is of course not good for the banks because they will not be able to recover their lendings. But what we can see from this table right here is that following the thick red line, it did come from 7% back in January 2007, and 8%, and now at where we are right now in 2022, this level, the GIL ratio, the gross impaired loans, we are at a level that's below 2%, and this is a level that we have been since 2014 itself. It's a curious case, but I would like to think that it's really thanks to our economic prosperity. Having seen our country being able to sustain economic growth for quite some time, income levels are rising, and hence the risk of defaults are also diluted as well because of that. So a lot of this really does show that Malaysia as a country, we are still not that bad. We are developing, albeit not at a developed status yet. But still, this does give some level of assurance to show that as a country, in terms of income per capita, not the highest, but at least we are still able to operate in a very sustainable level, and also in a level that shows improvements. Right, but that's it. Although that's where we have been trending over the last decade or so, I think the more important readings will be where were we during the last 2 years itself, during COVID and during the MCO. But I'm also happy to show that given the current levels itself, we are probably erring towards the highest side of this band over here. But I would have to say that this is still within what I would call a normal level. And of course, during the two moratoriums, during this period of April to September and July to December, of course, when you do not have to pay or when you do not have to facilitate your loans, it is a bit difficult to understand whether there is a higher risk of defaults or not, because by the virtue of being able to not commit to your monthly payments, it's hard to say whether you are actually in a good financial health or not at this moment. But looking at this, even though during the months after the moratorium, we do see GL creep up a bit, but it's not a very exponential move upwards. So hence is what I would like to call still within the normal level. And we are now in the month of August. The June readings are still relatively stable. Of course, it's coming up a bit because we are after all just post moratorium, but still, it does give some sense of assurance that we are again, operating in a fairly sustainable and healthy environment in the whole financial system. Okay, so now to touch on to this, my presentation here is a bit visual, but what I would like to show is two different um, investment methods when we want to look at the banks. It might be a bit simple, but I think it does give a rough idea as to where you might be if you were to position yourselves in banks in a certain way. I will start with this. This is how the banks have been trending on a year-to-date basis from this year. As we know, 2022 is probably the start of it's the start of our economic reopening. Um, but the highlight that I would like to show here is the two dotted lines. We can see a black one and a red one. The red one will be the KLCI, which is our benchmark index. The black one would be our Bursa Financial Index, which is the accumulation of all financial stocks within the Bursa stock exchange itself. But what I want to show here is that, relatively speaking, the banks are still holding up better than the rest of the market, with the exception of two banks, which are CIMB and Bank Islam. But although we are seeing CIMB come back up a little bit better over the more recent weeks or so. And I think the explanation here is really quite simple. It's because we are in an environment where we are hoping for recovery. And when we look for recovery, we also want to see which sectors would be the more direct beneficiaries for it. And that, of course, comes to the banks itself. And although, this does not really tell the whole picture as to all of the individual banks itself, but ultimately, if you were to position selectively, it still shows that irregardless, the banks are still viewed quite favorably amongst investors in the market. And also, I guess, in terms of headwinds, they are not as badly affected by the commodity cycles, unlike manufacturing, oil and gas. And I think the worst of all would be the gloves. But yeah, we're not here to talk about the gloves. We're here to talk about the banks. Right. So before I go to the wider scope of the investment strategies, just to highlight here what are the what are the biggest swings, or I guess what were the key instances in the past which did cause a massive shakeup in the market. And I'm highlighting the big four over here, not really touching on the ones that did not last over a year, which is like the, I think there was a SARS outbreak, as well as the euro default of Greece. That also did affect the stock markets, but it did not really last throughout the year itself. So I'm really highlighting the big four, which was the Asian financial crisis, the dot-com bubble, the global financial crisis, and of course the more recent one would be the COVID pandemic. And I will start off with this, which is the short game, as we would like to say. There's a lot of numbers here, but I would like to highlight the ones that are green and in blue. So what this shows is basically if we were to buy the banks, any of these 10 banks for that matter, at the beginning of the year and held it until the end of the year, how well positioned would we be when we closed our position? So really, maybe let's just take the first line, for example. KLCI, from the beginning of the year until 5th of August, which was when I cut off my data points, it did come to a negative 2.3. But at this moment, if we held on to Maybank, we will see a 10% growth. Public, 13%. Public also, I have to say that the bonus issue did help quite a lot as well. It added a fair bit of liquidity, and also a lot of, I guess the cheapness did bring some renewed interest into the bank itself. CIMB, as mentioned earlier, they are not one of the better performing ones, but because they are still better performing than the KLCI, hence why it's blue, but because it's a negative, hence why it's red. So that's really an idea of what this table is trying to show. And to explain how well you would have done if you had this strategy at the back of your head perpetually, we can see right here that all of these banks of the year of 1990 to 2021, Maybank, they did perform 59% or 19 out of 32 times better than the KLCI index. Same with Public, same with CMB is 50%. This is Alliance Bank, 17, 53%. And also coming towards a range of average returns, which I guess they are all still better than the KLCI. But coming back to this situation of the crises that we had, I think we can see here that, although we are in a positive level for some of the banks, the KLCI did improve more meaningfully than some of the banks itself. Probably the one that is a bit more damaging would be the 1997 period, where the KLCI dropped by 50%. But unfortunately, everyone else did drop more than 50%. But really what I'm trying to show here is, in the end of the day, even if we are to play ourselves as short-term investors, just to enter the banks on a yearly basis and maybe repositioning ourselves as and when the year rolls over, we are more likely than not still able to beat the index. But of course, these big three names, because they are the leading banks, I think there is a stronger sense of confidence over here. And Alliance Bank, it is a new favorite recently because they did show the biggest recovery amongst all of the smaller banks, which would be the likes of Afin, Mbank, Bank Islam, and MBSB. So ultimately, it doesn't seem like it's too bad of a strategy for the banks to hold it on a yearly basis. Sorry, as in to enter in and take profit at the end of the year. But of course, we are muddled by macro risk. It's not 100% guarantee that we will be able to come up with returns, but it is quite a comforting statistics. Right, so really this is just to visualize the chart above into a line chart sort of view. It might be a bit hard to see, but it does show that, when we do beat the index, we are significantly stronger than them most of the time. This is to show the small cap itself, but the trends are really the same. Okay, so what about the long game? Holding it perpetually. I'm not sure how many of us would hold the banks indefinitely, but this table will tell a different story. So if we were to hold the banks, I guess not take profit ever, the reading here will be a bit different. So as of today would be 5th of August. Sorry, as of my cutoff date, 5th of August. How much returns would we have gained if we had bought the bank or the stock since January, 1st of January of each of the years? So this first line would be to say that if we held it since 1st of January, Maybank would have given you a total returns of 10.7%. If we had held it since 1st of January if we had held the banks since 1st of January 2021, holding it for almost a good 2 years, that's 17.7%. Public would be about 20%. 1st of January 2022 until today would be 23%, so on and so forth. So yeah, you get the gist of it. But yeah, basically we see a lot of greens and a lot of blues over here. So probably by the looks of it, maybe holding the banks perpetually would be a sound strategy, because irregardless of the swings within the market, we do come out on top in the end of the day. And I'm not sure if any of us have been holding any of these counters since 1990 without selling them. But the likes of Public Bank does give you about the 10,000% return. It's not an overstatement. It did happen because there were a lot of, well, yeah, it just did happen. And I guess anyone who has been holding Public Bank since 30 years ago would be extremely happy at this moment of their investments. But, does that mean we should not start in the current period? Well, it's not to say that as well, because ultimately, if we were to play this long game, what will be driving our returns is really dividends. And banks, they are known to be one of the better dividend payers within the industry, within the stock market also. And although we do come to the point where capital gains or share price movements will be something that will affect us emotionally, in the end of the day, if you were to keep this really just for a long-term investment purpose, more likely than not, we are still in a very comfortable position with our portfolio. Of course, this is not for all of the banks. These are the banks. I guess more of it would be applicable to the top 5 banks. The smaller banks, of course, not as pretty as the top 5. But it's not to say that, if you did position yourself a bit strategically, like for example, Affin Bank, you are able to gain the likes of like 300%. Of course, it might not look so good over the horizon of 15 years or so. But to some people, that might be good enough because in the end of the day, I did triple my portfolio value. Bank Islam as well. But yeah, really, this shows that irregardless, risk to reward is still there. It's a matter of how aggressive we are in terms of managing our portfolio. By the looks of it, I think a lot of long-term investors for the banks are relatively happy with their investment decisions. So just to show this in the chart form, like I did previously, mostly, yes, we are better than the banks, better than KLCI. But this one is ex-public bank because to the point I mentioned earlier, public bank would really skew this chart to a degree that is almost incomprehensible. Again, to the smaller banks, it's not a very clear signal, but still there are opportunities nonetheless. Right. So with that being said, having spoken about where the banking sector is right now and the findings of that study I showed, what does that mean for us? I would start by saying that, at this moment, Kenanga, we are still very gung-ho with the banking sector. Although we did see some headwinds over the last few quarters itself, because when we did come to the period where the moratorium and repayment assistance programs did come in, a lot of the banks, they are still concerned about asset quality. And what that means is that there will be some provisions or allowance for impairments that will be registered within the books. And this is something that is typically frowned upon because that means that you're holding unhealthy assets. But it's something that's industry-wide, and hence it's also seasonal because we do not expect COVID and this cycle of impairments to happen perpetually. It's something that is mitigative in nature. We only see it because of the current pandemic, which we are really facing off at this moment. So I think there is more bright sparks for the banking sector really at this moment, and hence we do keep an overweight call on the sector. I will show you the general list of calls that we have for the stocks within our coverage, but really just to highlight the points on why we are more keen about the sector would be, number one, we're in a situation of a better economic recovery. So that will translate to better loans growth, as I did show in the earlier slides with the monthly readings. And number two, with OPR coming in at higher levels, that will translate to better net interest gains for the banks going forward. And number three, this is something that is a bit further in nature, whereby the write-backs that we did see over the last few quarters itself, the provisions that we did see over the few quarters itself, there will be eventual write-backs from there. And hence that will be something that will translate favorably to the investors of the banking stocks. And also, I guess something that is a bit not spoken about yet, but recall that this year is a year that we are seeing the one-off prosperity tax being imposed by the government. And I think we all have very varying thoughts about what this prosperity tax entails. But if we were to hold a longer term view on the banks, when we do come to a period without this prosperity tax in 2023, the earnings growth would be quite substantial. And I think I'm probably looking at the range of about 30% for some of the banks. If I'm not mistaken, that would be CIMB. But irregardless, it does show that despite being one of the biggest sectors, we can still look forward towards growth going forward. And for this third quarter itself, we do have a certain strategy. Although it's something that I did highlight earlier, but I think it makes even more sense right now. It's because when we do look at the stock market, and there's a lot of fluctuations going on because of all the macro factors that was also mentioned earlier, we do want to look for safety. And with safety, what comes to mind is, of course, dividends. Whether we hold it just for the dividends and exit when the dust clears, or whether do we want to keep it as an alternative to FDs. In the end of the day, I still think it's a sound strategy. It will be something that we call a safe haven. Right. So before I go on to our individual stocks, really just to give a sense as to how banks are valued at this moment. We do prefer to use the Gordon Growth model. This is something that accounts for the efficiencies of the banks, which is the ROE, and as well as accounting for the book value of banks as well. Because in the end of the day, when we invest in a bank, we want to invest in their book value, or really at this moment is how much of the loans they're able to sustain amidst netting off their deposits. Really, or in other words, just the net assets. That really shows the value of the banks, because they are a high book industry. But this is the common methodology that we would use for the sector. Some of you may be using it for your own internal purposes, but this is something that is applied for the banks itself. And what I would like to show is really at this moment, the top table would be a summary of the fundamental, our model expectations for the banks. But the highlight here would really be our calls, our target price, and as well as our calls for the sector. We can see from here that we have 8 buy calls or outperform calls out of 10. And we do have a market perform for public and an underperform for MBSB. Public, although having showed that they are one of the better performers at this moment, but at least looking on the near-term perspective, we do think there might be some limit towards the capital upside. If anything, the longer-term investors, of course, they would be able to benefit from their dividends. But for the nearer-term investors, for those who are more capital upside savvy, probably other opportunities would exist in the other banks at this moment. MBSB is our only sell call or underperform call. I think for those who might have observed earlier, they are also one of the not so well performing stocks among the 10 in terms of both the long-term and short-term study. But really our caveat for MBSB is that although they do see a little bit more headwinds compared to the other banks, let's just remember that they are also going through an exercise at this moment, which is to assimilate MIDF into the bank itself. We are still waiting for more announcements to come, clarity as to where this is going to take the bank. But that's something that would only happen, I believe it will be later this month, or if not, up to October. There is a deadline that's been set by Bank Negara. But there is something to look forward to with MBSB. But fundamentally speaking, until we are able to see the assimilation of MIDF into MBSB, fundamentally speaking, I'm not too excited about the bank itself. Right, so with all that said, we do have some top picks for the sector. I think the Maybank one does not come in a surprise, because it does show to be one of the outperformers in both our studies. But we do think that Maybank has a lot of value to offer. I think most of us are, in a way, a user of Maybank to some degree, whether is it as a borrower or as a depositor or as a borrower. But in any case, I think the thesis is still fairly strong because Maybank, they are still the leader in terms of loans and deposits, in terms of the market share amongst the 10 banks that are listed. And, despite them being the largest, they do have a very good sense of how they manage the asset quality. The GL ratio that I did show earlier, they are still in a level that's better than the industry. And this might come to a surprise that the larger you are, probably the harder it is to control your operations. But that's really not the case of Maybank, and that's really why I am still quite gung-ho about it. And probably towards the long-term investors of Maybank can probably attest to it that the dividends are quite handsome, and they are still expected to be. 7 to 8% really does beat any FD products even in the past, and I do think it's a level that can hold at least in the next few years. Alternatively, we also like Alliance Bank, ABNB, and for those who have been following the sector, you can see that in terms of earnings readings, they are one of the better performing small cap banks. And also, if we do come back to the angle of economic recovery, which is an industry-wide theme for the sector, they are the highest. They have the highest proportion of the SMEs in their portfolio. And why this is important is because, coming back to the earlier point that some industries were badly affected by COVID, like the tourism sector, hospitality, some of the retails, and mostly they are still classified as SMEs. And if we are to expect that these industries were to make a comeback and then some going on in the future, then ultimately we do need to identify who is the one that can ride this wave stronger than others, and that would be ABNB. Also, fundamentally speaking, they are still, I guess more recently, one of the bright sparks in the industry because ROE, return on equity of 10%, they are much better than some of the larger cap banks even. And dividend yield of 6 to 7%, which is shy of Maybank. But of course, some people may not think too highly of a small cap bank because they are, to some degree, possibly a bit more risky. But for those who are probably a bit with a bigger risk appetite, you might want to think of ABNB as something to look at going forward. Tactically speaking, we also do like Affin, specifically for this quarter and next, because for those who have been following the headlines for Affin, they are trying to make their operations a bit more lean. They have recently completed the disposal of their asset management arm, Affin Hon, or we like to call it AHAM. There is no commitment by management as to how much they are going to give out as special dividends. But when the announcement does come, I think there will be quite a strong interest given towards Affin itself, and what that would mean to the share price, I think it's anyone's guess, but I would be quite confident to say that there would be a knee-jerk effect if there were any announcements to be made going forward. AXA Affin, AXA Affin, their insurance arm, they are also trying to restructure it to be a bit more lean by moving it to a subsidiary to be an associate. Management is also quite confident that the net gain of it with their JV with Generali Insurance would be a net gain for the bank as a whole, even though it's being reclassified as a subsidiary to an associate. But still, again, coming to the point that we might be able to anticipate some knee-jerk effects post the completion of its restructuring. But all that being said, it's not. We are still confident about the banks. It does show a lot of opportunities that we believe in, and I think that ultimately, in the end of the day, anything that would affect the stock market in a more macro way will be something that will affect everybody. And And of course, that is really just a call for us to be more prudent about how the landscape will evolve going forward, because there is never any assurance as to what's going to happen tomorrow. But at least I hope with this presentation we do have an idea, or at least some confidence on where to look at. And also hope this is useful for your investment strategies going forward. Thanks for your time. Shane, can I pass it back to you?
All right, thank you so much, Clement, for sharing with us the insights into the banking sector in Malaysia. So if you have any questions to ask our speaker today, Clement, please write them in the Q&A box, not the chat box, yeah? Now, Clement, we do note that your webcam is frozen. Okay, would you want to turn off your webcam and restart it again? Because we can no longer see you after you started talking about the recommendation and calls.
Okay, give me a minute.
Yeah.
Okay, sorry, I'm not able to start myself back up again, but I think you can hear me all right, right?
Yeah, I can hear all right. Okay,
Okay,
so
technical
glitch
issues.
with your
Yeah.
webcam, right? Okay, no problem. All right, so if you have any questions for Clement, do send them over at the Q&A. The first question is by Maslan. Is there a reason why Bank Islam, performing fairly badly?
Okay. I would have to say, okay, I guess this applies to MBSB as well. There is nothing to say of the way they operate, but if we do look on a more macro basis, they are still the banks that are more exposed towards the lower income brackets, and also not too heavy onto the higher interest products within the industry itself. And also, if we do look in terms of an asset quality basis, they are not the healthiest. Maybe that is also partly to do with how they manage their assets. But ultimately, all these things are really it's all accumulation of the macros in the end of the day. Like, they might be able to service the lower income brackets a bit more efficiently. Maybe the confidence in them is a bit stronger within those communities itself. But for investors, and I also would like to think mainly institutions, because the banks is one of the key sectors, right? They would not they would rather put their money towards names that are a bit more resilient. So, again, it's not to say that these banks are performing poorly as well, but there is stronger sentiment attached to the other banks as to why they're not getting as much support. But also, again, fundamentally speaking, it's not to say that they're performing very poorly. It's just a matter of exposure and perception going forward.
Okay, now Jane would like to ask, why is MBSB at the bottom two?
Bottom two, well, in terms of stocks, in terms of the price performance, I think I did mention earlier it's as well. But fundamentally speaking, I guess MBSB they probably have a bit more. They are looser in terms of how they manage their assets. And if you do look at between the banks, maybe I'll just show it right. Okay, I don't have it here. But they do have the poorest asset quality readings amongst the banks. And I also think that that would be a cause, that would be a reactionary cause for investors as well. When you do see that a bank is likely to face a risk of default, then you might not be too confident with that bank going forward.
Okay, understand that. Now, there seems to be some rumors that there will be, potential merger and acquisition among this banking sector. What is your view in this area?
Yeah, we do get asked that a lot. I think consolidation will be healthy, definitely, because in the end of the day, why do we want to consolidate? It's because we want more. It's basically a way to weed off any of the more inefficient players in the industry. So maybe let's not look on a bank-wide basis, let's look on a more divisional basis. I think recently one that has happened is Alliance Bank. They did dispose their stock broking business because it really did not do any good for the bank, really. And they disposed it to a non-bank. I think it's Phillip Capital, if I'm not mistaken. But this is also a consolidation, and it's a way to help the bank to become more efficient going forward. On a larger perspective, it might be a bit more nuanced because if we were to take the example that is usually the biggest suspect would be M-Bank and RHB Bank. This is something that's been spoken about for many, many years now. There will always be a cost when it comes to mergers, which the banks will also be very realistic about. Operationally speaking, you will need to be able to sync the two businesses together. In terms of branding as well, who would be the one that stands out, who would be the one that gets weeded out, and also in terms of manpower duplication, that's something that's also not an easy thing to settle. And it really does make the discussion of interbank merger very difficult. So at this situation, looking at this situation right now, I think the more recent one is that came out recently is from Hong Leong Bank. Tan Sri Kwek is looking to possibly dispose his holdings, but it's a rumor. I think it's all speculative. Nothing that is too grounded on that as of this moment. But yeah, I think if there is any consolidation, it should really be on a more divisional basis. And of course, if you want to look at the reactionary movements to share price, I think it would be a net gain for the two names that might be involved in the discussion, because one, they would have the gain of disposal from letting go their non-efficient assets, and the acquiree would probably gain a bigger market share, which also would be a positive reaction towards their share price. But sorry, it's not really a straightforward answer, but I think this is how we can best explain the situation here.
So you mean in the merger between two banks, usually the acquiree and the acquirer will see their share price gain, am I right?
On a divisional basis, I would say. As in like maybe if one investment bank gets absorbed by another bank, but not as in the whole group per se.
So what do you think will be the impact of the potential divestment of the Hong Leong Bank's biggest shareholder?
I think it would be honestly, I'm really not subscribed to the idea because Hong Leong Bank, they are one of the more efficient names in the market out there. And if anything, I think they should be the one acquiring people because I think if we look on book value and also in terms of valuations, they are one of the more expensive names out there. And if another bank were to absorb Hong Leong's books, it would actually dilute their asset quality because it is that low, below 1%, I believe, where the industry is looking at about 2%. And also, whether anyone is willing to pay the current price for Hong Leong, that's also another question because Hong Leong Bank, they are not the largest bank in the market. They are number 4. So it's not really something that I can subscribe to at this moment.
All right. The next question is, why do the net interest margin of banks rise despite the deposit rate also rises? Is it because the lending rate rises steeper than the deposit rate?
Okay. I guess this is referring to my earlier chart. We have not really seen that happening as of this moment. We would need to wait until we get the third quarter results in November to really validate this point. But in the past, when we do see the OPR levels come down to the level of 1.75, the rates of deposits did drop down more aggressively than the rate of lending. So that's why we do see that increase in interest margins for the banks. And at this moment, we're not really seeing much changes as to the lending rates, but because interest rates are so low, and banks, they are in the business of taking deposits and using the deposits to lend out. So a lot of them, they are trying to take advantage of this low interest rates environment before the rates do go up, because when they do go up, there will be some migration towards fixed deposits, and ultimately, if they were to just wait until their customers enter at the higher fixed deposit environment, then they will not really be that cost efficient. So hence why we're really seeing this trend whereby there's a bit of a flattening of the interest margins in the last few quarters. But also coming back to the point that I mentioned earlier, because now we are seeing the OPR going up, so the lending rate will go up probably more aggressive than the rate of the deposits as well. And even if they do sustain, the difference between a 3% loan and a 2% deposit, it's still sizable in the end of the day.
Okay, so you were saying that when the OPR dropped below 1.75%, the deposit rate drops more aggressively than the lending rate. Am I right?
Yep, that's what maybe let me just go back there. That's really what we've observed in the market, and I guess this is a dynamic that would not really repeat itself.
So that happened only once, is it?
That happens during this period, the third quarter of 2020, going forward. But coming towards the more recent periods over here, that's where we see it's starting to flatten quite meaningfully, because when levels are normalized, that's where competition can be more prominent.
So we expect that going forward, when OPR is raised, then the net interest margin for the banks will also increase,
Yep, that will be
All right.
It will be two-pronged, basically. Lending rates will go up, but borrowing rates will also go up.
But the lending rate will go up steeper,
That's hoping, yeah. Not for us, but for the banks.
Okay, now the next question is by Zheng Yu. Banks have not been paying out dividends during the pandemic in 2020. So how should we diversify the risk if we buy banking sectors for dividend income?
I think this comes back to whether you're taking a long-term view or a short-term view. The lack of dividend payments in 2020, I think it's also not industry-wide. Probably the ones that did escape the dividend payment was M-Bank, if I can remember. But M-Bank was a unique animal on its own because they did have to face that 1 NDB global settlement issue of 2 billion. So that did impede their ability to pay dividends. But otherwise, most banks, they do pay dividends on a half-yearly basis. And coming again as to what is your strategy, because if you are to look on a long-term perspective, meaning to hold more than 1 year, if you do miss out the dividends on this year, at least you will still have the dividends for next year. And structurally speaking, also shown in my tables earlier, there will be a high likelihood that the banks will outperform the index. So even if you do miss out the dividends during that year itself, more likely than not, if there's any macro recoveries, the banks will also see strong capital gains to make up for the lack of dividends. But of course, this is really a blanket. This is a blanket commentary. Different banks will, of course, have different exposures. I guess to be a bit more nuanced, CIMB, they do have Indonesia and Thailand as well. Maybank also have Indonesia, but also a bit of Singapore. RHB also has Singapore as well. So on a more macro basis, these regional diversification would probably have some impact as to how the market will react to the stock. But at least on a broad basis, there is still some level of comfort that we can have.
Okay, thank you, Clement. What is your view on RHB? So this is a question by Chi Hian.
RHB, well, I guess we do. It's still a buy call for us, but it's not the highlight for this quarter at least. But we have been, the commentary for RHB has usually been quite consistent. It's a bank that we would invest for safety, but not dividend safety. It's more of a provisional safety, because in terms of capital adequacies, they are the largest bank. They are the bank with the largest capital safety amongst the peers in the market. But what this means is that they basically have a lot of reserves that can be used for provisions going forward, and that would not be something that would damage their P&L too badly. But also having a lot of capital does mean that eventually they might consider using it to funnel into dividends, but that is not the tone that we've been getting from the bank at this moment. So it's a bank that I would recommend to buy probably back then when we were in COVID, if you're looking for a bit more safety. But in terms of dividend payments, they are fair, but they are not one that stands out that drastically in my books. But of course, if you look on a longer term perspective, then it's still something worth looking at. And plus their digital banking license with Boost, who's to say that that will be the leader in the digital banking space going forward? And if they are, I think a lot of people are more familiar with Boost, so the penetration will be stronger. And maybe there will be also some positive reaction from there when they do launch their products. So yeah, again, it comes back to how long of a view do you wish to put with this bank?
Okay, thank you, Clement. Stephen Patrick would like to ask, how come public bank is not in your top 3 picks? Is it because of its higher exposure to the housing loans?
Right. Yeah. So this is back to the caveat that even though public was one of the better performing ones in the long-term and short-term strategy, but our recommendations are really more on the short-term perspective. Actually, within the 1 year itself, public bank at this moment is what we would call fairly valued at current levels. It is the only whole call out of the out of the 10 stocks that we have. And also because to the point of its high household housing loan mix, I would think that maybe there is a bit of struggle to grow this segment going forward because with interest rates coming up. But also my main point here is that they are not really the best dividend payers if you were to enter in this current level. For those who did enter back in the probably a couple of years back, you will be able to see better yields on your own personal portfolio. But for new entrants, it's a bit unattractive compared to the other banks. Hence why it's a whole call for us.
Okay, so in near term, not public bank, huh? So for yes.
No, near term, not public bank. Yep.
Yeah, so if near term, not public bank. Near term, probably the next question is by help me is Maybank good for short to near term?
I think it's really good for both at this moment. Because one thing that I believe is unaccounted for Maybank is that really I like to come back to the point that even though they are not not the best contributor in terms of their ROEs, not the industry leading. Public and Hong Leong is the industry leading, but still, if we do look on an operational basis, the fact that they are still the leader in market share, but still able to hold asset qualities that is better than industry average really does say something about how they are managed internally. And also, I guess one thing that people would say about Maybank is that it's very institutionalized. But Maybank, they do have that dividend reinvestment scheme. So in one way or another, there will always be added liquidity to the bank. So there will not be, I guess basically there will not be a shortage of potential interest to buy into the bank. It will always be accessible to the market.
Okay. Now, what is your comment on the grandfather rule of Bank Negara exempting public bank and Hong Leong Bank, limiting the shareholder stake to 10% or less? This is a question by Francis Leong.
I mean, I guess what they're trying to do is that they want to divest control, isn't it, in the end of the day? But ultimately, I believe long-term investors, they do follow where the management goes, and if in the end of the day, if this is something that will cause the bank to change operationally speaking, then it's probably something that would also affect. It will affect the how shareholders would behave towards the bank itself. Whether is it good or bad, I think it's a bit soon to say. I'm more skewed towards the negative side now.
Okay, thanks for your feedback. Now we know that just now I talk about digital banking, right? So the next question by Jane is now, how will this affect the traditional banks' earnings and growth going forward?
Right. I guess one of the questions about this that we do get is because digital banks, they are new, and when you're a new player, how do you penetrate the market if not by pushing prices, or in this case, offering interest rates, deposit interest rates that are potentially much more aggressive than your traditional players, right? So to that extent, I think that there will definitely be some degree of tightening in competition. Because I guess personally for myself as well, if I do see maybe Boost RHB offer FD rates of maybe 5%, for example, I would definitely jump the gun and take it. But they are limited by Bank Negara's rule that you have a cap towards your asset size. I believe it's 3 billion. And what this means is that they can start with these products, but I do believe, like even for example, that 5% FD example, there will probably be a limit as to how many people and how much they can put within the bank itself. Because in the end of the day, the purpose of this digital bank is really to increase the penetration in the underserved communities. Underserved communities are those that are the micro SMEs and also those retailers who need microloans. And these customers would probably be someone that will not be able to get their loan application approved in the normal bank because their risk is just too high. And so to be able to balance this risk, the banks themselves have to be able to find a middle ground between their cost of sales, or in this case, their interest expenses, and as well as to how much premium they can charge these not so healthy accounts. So to this degree, I would not say it will be very out of hand. It will definitely be there, but it will not be something that will shake the sector too aggressively. But in any case, I think we will all want to participate with the digital banks, because most of us, we do have a e-wallet, right? So any integration with the e-wallet, I think is something that will be quite exciting to look forward to. But they will not. I don't think they will come to the point that they will be as big as the traditional bank, at least in the next 5 years after they launch.
Okay, thank you, Clement, for sharing your perspective. Now, if we expect the economy is going into a recession, do you think that now is a good time to buy your top picks, or it is better to wait for the next recession to take place first? So this question is by Peter Chin.
Right. Well, we are aware of this as well. But I guess coming back to the strategies that I did present, it's really 50-50 to some of the bigger banks, right? But then it again comes to the question of whether do we actually end up in a recession or not? Because if we do not end up in the recession, then there will be some missed opportunities. Well, not to take this as direct investment advice, but I would probably not go all in, but I would like to at least have a comfortable position that in case if we do not end up being in the bottom end of the economic cycle, we are still able to benefit a bit from the capital gains and dividends from here. But of course, if the recession does come in, then most of the share prices would come off, banks included. Then maybe average down would be a good strategy as well. But in any case, I think, coming back also to this point, if we are looking on a longer term perspective also, like even here, the demand for loans will always exist, regardless of what kind of situation we're in. And of course, it's not just a simple, it's not as simple as just looking at one statistic and then taking that statistic and running with it as well, because there is a lot of moving parts in the end of the day. But at least from what I can show, or at least what is proven within this itself, is that ultimately it's a matter of probability, and the probabilities are still quite high that you will be the net benefit if you do position with some of the banks.
Okay, thank you, Clement. The next question is by Hai Chiu. Now, our ringgit may deteriorate severely against other currencies in the future. So how will that affect our banking counters? And how do we hedge ourselves from this? Other country currency may also depreciate too. So foreign share ownership is also risky then.
Right. Yeah, this is also one of the, I guess, more macro elements that is a bit worrying for us at this moment. But I guess fundamentally speaking, we need to look again as to what is the net impact of forex towards our economy. Of course, we do imports as well, but if you do look on a more national basis, I do believe we are maybe net exporters because we do have a lot of manufacturing arms as well as the tech, those tech manufacturers in the country itself. And these industries are going to benefit from the higher forex rates. Of course, if you look on the commodities perspectives, maybe on the more local, I guess for the likes of those who are net importers, like your poultry segments, there will definitely be some damage going forward. But those are not solely affected by forex. Also, those have their own commodity cycles. So in that sense, it's a little bit hard to pinpoint which exactly would be the ones that will be more damaging towards the overall sector. But in the end of the day, if you want to look at it, the banks, they are not only exposed to one certain industry, they are exposed to the whole basket of the economy itself. And actually, well, I do not have it here, but most banks, they do have a 50-50 mix. 50-50 meaning 50-50 business and 50-50 household. And I think this really is also translated here. Yeah, it's also translated here to some degree. We are not purely dependent on business loans. And the household loans is also really coming from our local retailers in this extent. Of course, we do want the economy to benefit, but in the end of the day, it's not just one single sector that the banking sector is dependent on. It's the whole economy. And I think at least in this environment, net inflation would be the biggest concern as opposed to just the local, our forex rates on a global level.
All right. Thank you so much, Clement. The next question is by Jane. How about other financial counters such as Aeon Credit, Eldesa? Are they doing much better than the local banks? And what will be the risk for the growth in the future?
Right. Well, sorry, but I don't cover ELK but I do cover Aeon Credit. But what I can say is that generally they will still be beneficiaries of the economic reopening. I guess Aeon Credit on to some degree, they are not as focused on businesses like the banks are. They are more retail driven. I believe their mix is more of motorcycle, personal financing, and also also maybe credit cards to some degree. And taking that note, when we come to the discussion of economic reopening, this also means there will be higher retail spending. And when there's higher retail spending, there will be higher appetite for debt. And that's also something that we are seeing, in this table itself. Household loans are still coming up. It's not just fueled by property purchases, it's also higher purchases and personal loans itself. So I guess what this means is that we are still healthy. There is, I guess the term that people like to use is revenge spending. Like we have not really spent so much during the COVID itself, so now we have flush with cash, and I know we're trying to spend it. But in the end of the day, we still see quite healthy demand for financing, and I think it's something that will continue at least for the next few quarters. Of course, I think the number one kicker would be if COVID does come back again, which I think it might be unlikely, but that is the one thing that would stop the sector almost immediately. Yeah, but that would affect all sectors and every stocks in the market.
Yeah, especially the loan moratorium, which is pretty damaging to the sector.
Yeah, exactly.
The next question is by Ting E. Now, how do you classify banks? Yeah, do you see them as cyclical counters or do you see them as growth stocks? So I think he left a remark that he felt that Public Bank and Hong Leong Bank should fall under growth stocks. Is there any explanation for that?
Okay, well, I guess this comes down to how we value the banks, right? Hong Leong Bank is still a buy call for us actually. And we are still we still do like the name. But again, we come back to our investment strategy for this quarter itself because I believe that the highlight at this moment is still really on where we are on a more macro level, right? Because the Russia-Ukraine conflict has not ended yet. Commodities are still a bit out of control, and in the end of the day, even though right now we are still seeing some small recovery in the overall index and the overall stock exchange, but there is still some risk as to how badly things can turn if something else were to come into the picture. Um, so yeah, so right now there is no discrimination as to the long-term view of the other banks. It's just that the positioning, at least in this moment, I'm more skewed towards the names here. Public Bank, I think also alluding to the earlier point is that it's not to say that it will not be a strong performer in the long term, but at least in the near term, we do think it's fairly valued given the current fundamentals that we're looking at for the banks.
Okay, thank you, Clement. How do you evaluate the value of banks? And how should retailer like us, evaluate banks?
Well, I do like to share this.
Yeah, you use a Gordon growth model, right?
Yeah, it's very technical. But in the end of the day, we look at the book value of the banks because it all comes down to how big or how much of a market share the banks have and how efficiently they do use what assets that they have. Hence why we have the component of book value per share as well as ROE going forward. Of course, we do have a growth component as well, but if we do take this Gordon growth measure of a cost of equity, why this is here is really because we take the banks as a very big proxy towards the overall economy and to some degree the stock exchange, right? So this cost of equity component is a device that we have if we want to compare the banking sector across other sectors as well. So hence why this Gordon growth method is quite favored amongst the banking space. It's quite technical, but for us analysts, in the end of the day, we do want something that is a bit more fundamental when it comes to evaluating our stocks. So for the banks, we do come back to book value per share. And I think one question I do get sometimes is that why some of the banks they are below one-time book value. I mean that's just how valuation works, right? Because in the end of the day, it's not to say that if you do invest in CIB, for example, you will get exactly the same value as to one-time book value for CIB. In the end of the day, it's also going to be other moving parts as well. They might not be as efficient as the other banks. They also might have some troubles with their cost management. I mean, just generally speaking. But what we do see is that the valuations do to some degree have a bit of an academic aspect to it, and hence why it's the method that we do use going forward.
Do you feel that for any banks that who has their price to book value below one would mean that it is a good bargain?
Yeah, so like I just said, not exactly, because it's not to say like I guess Affin Bank, if the book value is 8 ringgit, that means if you invest in the bank, you get 8 ringgit back. You know, it doesn't work like that. And I think the argument also works for the net. If you want to look on a net cash per share basis, I know there are some counters that they are maybe like 18 cents and it's like 20 cents net cash per share. Of course, it does seem like as an investor, we are getting good value out of it, but it does not mean that that is the value that is going to end up in our pockets. In the end, it's all about sentiment, and the sentiment does not reflect that the stock is worth one-time book value. So it's not as simple as making decisions based on that. That's what I can say.
Okay, so essentially is price to book value a better metrics in comparison to PE?
For the banks, it will be because PE is something that we do use um, I guess companies that excuse me, PE would be more favored towards companies that could probably show very exponential earnings growth going forward. I think this is more picked towards like the likes of manufacturing, because for manufacturers we do try to look at how fast they can grow their businesses, and to that nature, that also ascribes to how much PE we can give towards the growth that we're looking at. But for banks, what we are growing is really your what we start to grow at the first place would be your loans books anyway. So, but it doesn't mean that you grow your loans books by 10%. That means you have an earnings increase of 10% as well. There are a lot of factors that comes into play that would affect how efficiently you get to churn out this 10% growth in loans towards your bottom line, right? So, hence why it's not as simple as using PE. But we are able to draw some historical trends as to how to measure PE amongst the banks. But it's just that, given the academics that we have on the sector, it is a bit more sound to use price to book, at least in my opinion.
Right. So that's what we retail investors should remember. Okay, PV will be a better matrix in terms of evaluation of a bank. For the long-term performance of banks, right? How do you factor in the dividend payouts? So this question is by Yip.
Right. So I guess this is where having a long-term coverage also helps as well, because what we can say is that even though I guess the example that I like to use, and also the example that gets questioned a lot, is that Maybank, management has always been saying that they will only pay 60% of their earnings. But if you do the calculations historically, they in fact have always been paying 80%, and they have never not paid below 80%. So the confidence is really there to expect the same going forward, and that's a conclusion that we can draw when we look at the numbers historically speaking. Of course, there might be some blip years amongst the banks. For example, like M-Bank, as I mentioned earlier. But that doesn't mean that there will be a new norm because of this one-off instance, right? Because it is a one-off. Coming back to that point, and Maybank, who's to say that they might be, touch wood, slapped with a fine like that as well. Maybe then there will be an exclusion, but of course we do expect a normal rate to come back in the subsequent periods. Hence why we have this we do have this assurance that historically speaking, there is some level of sustainability in terms of the dividend payments.
All right, so I think that shall conclude our question and answer with Clement. So thank you so much, Clement, for sharing with us the insights into the banking sector outlook. I think we all have gained enormous value from this session. So thank you, Clement.
Thanks, Shane. Thanks everyone for joining.
All right. So for our next webinar, for our next Can Trade webinar, it is titled Basics of Day Trading 101. How to day trade the market profitably. Okay, so that will happen on the 8th of September 2022. It's a Thursday. So the time is from 8:30 to 9:45. So if you want to register for this session, you may go ahead and register at the link that I have just given you in the chat box. All right. So it's happening on 8th of September, Basics of Day Trading 101, where we are going to go through the essentials of day trading skills, and then what are some strategies we can use to day trade the market profitably as a living. If you still haven't had a Kenanga share trading account, you may fill up this online form at www.cantrade.com.my/open-account-form. That's where you can put in your interest to open an account with Kenanga, and then Kenanga will arrange a friendly dealer representative to cater to your needs to open a trading account. And if you are looking for some trading ideas, to trade the market, then you may join the Kenanga Trade to Win Telegram channel, where you will get a lot of trading ideas on what stocks to buy, what is the TP, what's the stop loss. You know, you can get a lot of trading ideas from Kenanga Trade to Win Telegram channel. So remember to subscribe to that. So with that, I would like to thank all of you here for spending your precious time with us this evening on this Can Trade webinar. So hope to see you all in our next Can Trade webinar on the 8th of September. Bye, everyone.